I'm really struck by how the consensus at the end of each year, be it last year, the year before that, for bonds just feels like it's been wrong every single year. And to start this year, it was yields are moving higher, we're going to get inflationary policy. But bonds have been working, to your point, when equities have fallen. How hard has it been to convince clients of that they should be in this treasury market?
So I think some clients get it. We're seeing significant inflows into bond funds. I mean, cash has felt good when you're getting 4% on cash. You know that money is safe and you're earning 4%, which is actually above inflation. So people say, I'm getting positive real rates. High quality spread product is giving you 6%. If you can go into high yield, you're getting 7%. So we are seeing inflows. I think people who are saying equities have had a great run, maybe I take some chips off the table or I take some of my cash and put it in bonds. But there are other people who I think are not looking at the correlation in the last 2 months, who are saying, okay, maybe equities don't go up 25% every year. And so if I do want to keep some powder dry or I want to take some risk off, I'm moving to cash. And it's to those that I would highlight DeepSeek Monday, Tariff Tuesday. I need something for Wednesday, or maybe new home sales Wednesday. You look at these days where you get, whether it's uncertainty, whether it's, there was that COVID headline on Friday.
Yeah.
Any headline that pushes risk assets lower, actually bond yields, treasury rates are moving lower. So I think rather than looking at the 2-year correlation, I mean, in 2022, there was no correlation. The correlation was opposite because the Fed was hiking. Unless we talk about Fed hikes, I would argue that correlations are here to stay. So for people who are getting nervous about the stock market moves, actually bonds will allow you to stay invested in stocks because this is an asset class which will make money if risk assets underperform. I think as people see that, I hope that they'll then say, well, I'm getting yield and I'm getting diversification. Both of those were missing in fixed income for a 20-year period. And I think that's why people have been underinvested in fixed income. Some are seeing it, and that's why I think you're seeing the inflows. But I think that $7 trillion in cash tells me that there's still a lot of people who want to see these correlations continue, but rates are moving lower. So you've missed out a little bit if you have not been buying fixed income. You're still at 4.3 on the 10-year. I think given where Fed funds is, we think the Fed's going to cut a few more times. I think that 10-year is going to move lower, closer to 4%. And if you get a recession or slowdown and the Fed's cutting more, that 10-year can move a lot lower.